Hi, everybody. I'm just taping this. We're going to go through the homework that was due for the 11th and do a few more slides so we can finish off what we need to discuss with this unit. So once you grab your book, turn to page 240 and get your homework out. We're going to start with QS/2. And let me just pull you over here so that you can see what we're doing. So again, this is QS 6-2. I'm gonna just do from the book, and then the rest of them I'm going to work through with you on the spreadsheet. So the first question here is, I got a car for $14,000, free on board shipping point. So what am I, let me just make sure I've got the right screen shared, sorry. So what costs of the items that were lined out actually are included in the cost of the vehicle of the inventory, and it's anything that we use to bring something to our place of business and get it into our warehouse. So in this case, obviously the cost, that was FOB shipping point, so I paid for it. So it's everybody, it's the freight costs coming in, it's the duties cost, it's insuring it while it comes across, the other three things, advertising, sales staff salaries, and trimming the shrubs. I'm not quite sure what that has to do with anything, maybe on the car lot. Those are not included in the inventory, but these three costs were necessary. So that was a piece of bringing it over, and that's included in your inventory. 6-4, this is computing goods available for sale. So just really quickly see if you can, in your mind, outline what you think the model is for cost of goods available. And we worked on this before. So it's your beginning balance and plus all your purchases. Plus all your purchases brings you to cost of goods available. And then, as you well know, the two things that happens to that, goods that are available to sell, is they either end up in your ending inventory or it was your cost of goods sold. So really that's what this whole unit's on, is we've got to get to cost of goods available, and then we need to figure out what part of that is allocable to ending inventory and what part of that is allocable to cost of goods sold. So in this problem, we started with $10. It's 60 bucks a pop. We made these purchases. So at this point, we have 50 units available for sale, $3,180. So LIFO, FIFO, and weighted average are going to give you different answers on how to allocate that between those two areas. And again, this doesn't per se show up anywhere, but the ending inventory shows up on your balance sheet, and the cost of goods sold is, of course, your largest expense on your P&L. So then we had a set of data, and we had to do FIFO, LIFO, and weighted average. And weighted average is kind of the trickier of the three. So first in, first out means that your oldest stuff is in cost of goods sold and your newest stuff is in inventory. So you should always be able to set up a spreadsheet, or just on a piece of paper, write it out, and set up your three headings: dates, cost of goods purchased, cost of goods sold, and your inventory balance. So don't forget to plug in your beginning balance. I started out here, let's see, my data is on 6-5 with 320 units at $3 each. And then I made this purchase, So then you've got to write them out again. I've still got the 120 plus the 80. And then over here, make your total. Here's what my total balance is. Then on the 25th, I got another 100 units. So now I come over into my inventory balance, again, the 320, the 80, and the 100 at 334. So I've got $1,550 worth the inventory at this point in time. And then I make a sale and I sell 350 units. So with first in, first out, I can pick up the first 320. First in, first out, I'm selling the oldest stuff. I pick up 320 from here and 30 from here. So my 350 units then is $1,056. And I pulled that out of inventory, right? This is what I had. This is my COGS. Therefore, what's left in inventory? $494. Okay, so that's my balance sheet number. This is my P&L number. Okay, same spreadsheet for LIFO. You know, there's nothing different here. I'm still bringing in these different batches at the different prices or the different cost bases. But this time when I sell 350, last in, first out, I've got to go up the column. So I pull 100 from here. I pull 80 from here. So 350 units minus 180, I've got 170 left. Those are coming from here. So my cost of goods sold, as you can imagine, without looking, in a period of inflation, LIFO, my newest stuff is in COGS, is going to have a higher COGS than in FIFO. And same number, I had $1,550 in inventory, $1,100 was COGS. The balance of $450 is going to be on my balance sheet as inventory. So weighted average is a little bit trickier because each time we make a purchase, we have to recalculate what the cost basis is. In this example, it's pretty easy because you only have one sale at the end of the month. But if you had sales in between the purchases, you're going to have a different weighted average cost basis that brings that inventory into cost of goods sold at those different areas, at those different time frames. So here, again, same thing, beginning balance, always remember to put that in. So now I'm going to recalculate my weighted average. On the 9th, I bring in 80 more units. So now I've got 400 units, $1,216 is what it cost me. So I'm going to go to my calculator and take $1,216 divided by 400 units. My average cost is $3.04. Like I said, that's not helpful for me here because I don't have any sales. So then my next set come in at $3.34. So I'm carrying this weighted average down here. I've got 400 units in. So as you can see, you lose that individual cost basis. And now all 400 of those are at 304. I bring in another 100 units. So now I'm going to figure out 1,550 divided by 500 units. My new average cost is at 310. So when I make the sale, I'm going to pull those out of my inventory. So credit merchandise inventory, debit COGS for $1,085. And of course, this 1,550 is allocated between these two numbers. I've pulled that out to COGS. What's left in inventory for my balance sheet, $465. Okay, the next one that I asked you to do was 6-20. And this is just a math problem, right? So they asked for different numbers. So you had, everywhere it's purple, you had to solve for the number. We know that sales, which again, you should be able to do this model in your head, sales minus sales discount minus sales R&A equals net sales. So these are my net sales. Minus COGS gives me gross profit. So if I had gross profit of 35 and my COGS was 40, my sales was 75. And if my income was 13,000, what number do I have to plug in here? 22,000. So you can see here, this is just testing your very basic knowledge of the model. You also should be able to tell me the net sales model off the top of your head pretty easily. So that was 6-20. And then the next one that we're looking at is journalizing for E6-4. And just going through this, so we're looking back at the data from 6-3 and we're recording the journal entries, and they use FIFO. So they've got the table set up for us in E6-3. So we make our first sale on the 10th of January, and they tell us what we sell them for is $15 a piece. And you know, whenever you make a sale or whenever you have a return that brings merchandise back into your warehouse, you have 2 journal entries. So of course I record my sales and my AR at the selling price. And then FIFO, first in, first out. So I'm going to go to the oldest stuff, which is, was in my beginning inventory at $6 a pop. Okay, now I go down the road to the 20th and I buy another 60 units. So I record that just like you always would, debit inventory, credit payable, and now I make a sale. So I'm selling 80 units, debit AR, credit sales. But then the key here is when you make your cost of goods sold and credit to inventory, you've got to look up at your chart from 6-3 and figure out with FIFO, I've already sold 100 of those first units up here, right? So there's 40 of those left at $6. And the next 20 come off at $5. So it's just, you've got to set up that chart. Or no, I'm sorry, we sold 80 units. So 40 were left in beginning inventory, and then I have to pick up 40 from that next oldest purchase. And then lastly, on the 30th, I record another purchase. So the key to this is, you guys, is being able to set up always with these 4 column headings, and with weighted average, you have to recalculate the weighted average and carry it down to the next row every single time you make a purchase. LIFO and FIFO is just saying to yourself, first in, first out. So what I sold, I've got to start up here and move down. With LIFO, it's the last in, first out. I've got to start at the bottom and move up. So the last thing I'd like to do on this short slide is just finish, or this short video is just finish the a few conversations from the slides and from the chapter. So you should kind of have this in your head at this point, that in a period of inflation, obviously LIFO is always going to give you the highest COGS. So it's also going to relate to your most current costs, right? Your COGS is going to be what you brought into your facility most recently. So that's going to be current. And with FIFO, so this gives you a most accurate P&L, right? Because it approximates current costs. With FIFO, your COGS is your oldest stuff. So what's in your inventory on your balance sheet is your newest stuff. So this gives you a more accurate balance sheet. And with weighted average, that balances everything out, because as you see, you recalculate the cost every time you make a purchase. Specific identification we haven't talked about too much. That's really when you have super, pretty high cost things like, cars or jewelry, or you're not, you didn't buy 30 diamond rings and then do a weighted average. I mean, it's very specific. So you're like, oh, I sold Sam an engagement ring that I purchased from vendor X for $4,800. I mean, you're very specifically aligning your COGS with inventory that you sold. With FIFO, LIFO, and weighted average, in a period of inflation, LIFO is, of course, always going to be highest. FIFO is always going to be lowest. And weighted average is going to come somewhere in between. The opposite being, of course, with FIFO, inventory is your most current stuff. That's going to be higher. LIFO lower, and weighted average in between. Same thing every time we have to allocate cost of goods available between the two areas. So I think I told you when I introduced this that the IRS requires that whenever you use LIFO for your taxes, which is what most people do because it makes your COGS higher, your income lower, therefore your tax bill lower. You also have to do that for financial reporting. So you can't get the benefit of LIFO for taxes and FIFO for GAAP. And then the last big thing to talk about here is something called LCM, lower of cost or market. So inventory obviously is one of the major current assets for any merchandiser. And so there can oftentimes be big fluctuations in inventory. We're seeing that right now with supply chain issues and inflation, the fact that the market value of your inventory can fluctuate pretty greatly. So if your market falls below your cost, you have to write your inventory down. In other words, GAAP says, if you have 10 grand of inventory that you bought and brought into your warehouse, and then the market for that drops dramatically, that's actually opposite of what's happening now, but there's an oversupply of microchips. And so your chip inventory plummets, they make you write down the inventory. And the way that happens, so inventory must be reported at market value, and market is lower than cost. So, and that's defined as what it would cost you to replace those chips, not what you're going to sell them for. But, I bought 10,000 chips at $1 a piece, and right now I could get them for 60 cents a piece. So the replacement cost of that inventory is $6,000. So I'm going to have to actually write down my inventory. So in this example, we have a motorsports retailer, and they have two things in their inventory. They have roadsters and sprints. And they paid $8,500 for each roadster, and they paid $5,000 for each sprint, right? Cost. But right now, the replacement value, in other words, what they could buy the roadsters and the sprints for, it's gone down for the roadsters and up for the sprints. So the way that you work this is you've got to set up these three columns: total cost, total market, and LCM, lower of cost or market. My total cost you can get obviously by the 20 times 8,500. So I paid 170 for them, but the market value right now is 20 times 7 or 140, right? So you compare these two numbers, and your lower number is obviously 140. So then you do the same with the sprint. They cost you 50, but they've actually had some inflationary pressure. You would have to go pay 60 to get those right now. So the lower of these two numbers is 50. So when you add this up, 190,000, what did you pay for them? 220. Therefore, your inventory needs to be carried lower of cost or market is what GAAP tells us at 190, but it's sitting on your books at 220. So you need to credit your inventory for $30,000 and take this to cost of goods sold. Okay, so it's a journal entry to write down your inventory to lower of cost or market that occurs as an adjusting journal entry at the end of the period. And by the way, we're also required to do that for our investments in stocks and bonds. So if your company has a portfolio and the market goes down, you have to apply lower of cost or market there too as well. Okay,